Entering the end of the first quarter, Indonesia's domestic economy accelerates toward its seasonal peak. The Lebaran holiday reliably drives the country's annual retail momentum. Simultaneously, international investors are liquidating their positions in Indonesian markets at a rapid and aggressive pace. This divergence between local demand and international sentiment is quantifiable. By mid-March, foreign funds had recorded a net outflow of $1.1 billion. A capital exit of this scale suggests factors beyond local policy shifts or the quarterly earnings of individual Indonesian firms. We are observing a macroeconomic transmission. A localized geopolitical disruption in global energy supplies is triggering a broad liquidation of emerging market assets. Understanding this outflow requires tracing the shock through three distinct stages: the Middle East shipping bottleneck, Indonesian equity index hurdles, and state interventions protecting domestic banks. That $1.1 billion exit is the first symptom of a global capital recalibration, marking the start of a severe test for Indonesia's fiscal shields. The global risk-off sentiment began with escalating military tensions that restricted commercial access to the Strait of Hormuz. This choke point handles approximately 20% of the world's daily oil flow. Any restriction here creates an immediate global supply shock. Prices reacted instantly. Brent crude surged toward the $100 mark. For Indonesia, this translates into higher costs, fueling imported inflation. The state must bridge the widening gap between global market prices and fixed domestic subsidies, threatening the fiscal deficit. International fund managers typically respond to these dual threats of inflation and rising deficits by moving capital out of emerging markets. The United States Federal Reserve adds pressure. Sustained high energy costs keep U.S. inflation elevated, prompting the Fed to delay interest rate cuts until September. This hawkish stance supports a strong U.S. dollar. As the dollar remains the high-yield safe haven, liquidity naturally drains away from emerging market jurisdictions. The Middle Eastern energy crisis effectively forced global asset managers to reduce their Indonesian exposure, regardless of the country's internal economic performance. The $1.1 billion outflow shows that the liquidation was not distributed evenly across the market. Trading data confirms the sell-off was concentrated in large-cap, blue-chip banking stocks, the most liquid segment of the Indonesian exchange. These banks are currently trading at attractive historical valuation levels, yet this long-term potential is being ignored for short-term macro protection. The equity pressure was compounded by a second, internal factor, the MSCI rebalancing freeze. MSCI officially halted adjustments for Indonesian equities after flagging several major companies for highly concentrated ownership structures. The issue centers on free float, the amount of shares actually available for public trading. When free float is too low, the market is prone to liquidity traps and artificial price movements. Because of the freeze, passive global funds are prohibited from adding new Indonesian exposure to their portfolios, blocking a critical source of automated capital inflows. This created a dual shock, a geopolitical exit of active investors occurring at the same time as a structural freeze on passive ones. The equity decline is the result of a structural market vulnerability being exposed and then amplified by a global liquidity squeeze. To counter the flight of capital, the Indonesian government launched a defensive maneuver to protect domestic consumption during the holiday peak. The state had to decide whether to let imported inflation reach consumers or use its own balance sheet to absorb the price shock. The government chose absorption, maintaining domestic fuel prices at their existing levels, despite the surge in crude oil costs. This policy carries significant risk. Sustained oil prices near $100 will rapidly deplete the nation's available fiscal buffers. There is clear historical precedent for this choice. The administration has repeatedly demonstrated a preference for internalizing costs to ensure social stability. Securing the banking sector required a second, more direct intervention to maintain domestic liquidity as foreign funds departed. The government injected an additional 100 trillion rupiah from its cash reserves into state-owned banks, bringing total liquidity support to 300 trillion rupiah. This funding ensures that local credit remains available and that the consumption momentum of Lebaran does not stall. By weaponizing its balance sheet in this way, the state has effectively isolated the domestic economy from the geopolitical storm. This intervention explains a notable anomaly. Domestic sovereign bond yields are recovering, while equities continue to face heavy selling. Bond yields spiked early in the sell-off, but they have since begun to stabilize, reversing the initial trend. Bank Indonesia initiated this recovery by deploying targeted interventions to stabilize the rupiah against the dollar, providing a foundation for bond market confidence. The Ministry of Finance also implemented a pragmatic strategy for managing the national debt. To raise cash without saturating the local market, the government issued significant offshore debt, specifically through renminbi and euro-denominated bonds. Sourcing debt offshore keeps local bond benchmarks scarce and liquid, which preserves their value even as active equity investors pull out. Through active currency defense and diversified debt issuance, the sovereign state successfully decoupled its bond market from the broader emerging market panic. Examining the Indonesian economic engine following these dual shocks reveals a system capable of managing extreme external stress. The government is currently accelerating waste-to-energy and supply chain diversification projects designed to permanently reduce the nation's energy import requirements. These structural projects, however, offer no protection against the immediate volatility of the crude oil market. The growth trajectory for Indonesia remains stable, provided the government can successfully manage its fiscal buffers through this period of high energy costs. Global asset managers are treating this $1.1 billion outflow as a tactical retreat from emerging market risk, leaving the domestic growth story intact. The dual shock was countered by proactive domestic liquidity management, proving that in emerging markets, state financial engineering is the most effective defense against global contagion.